When we look ahead to 2026, the economy feels like a massive tug of war. On one side, you've got the hope for a nice, gentle slowdown. But on the other, there's this growing fear of something a lot more challenging. Today, we're going to break down exactly what top financial experts are seeing on the horizon and what it could mean for all of us.
So let's get right to it. Here is the big, multi-trillion-dollar question. Are we heading for a soft landing where the economy cools off without a big crash? Or are we looking at something much weirder, something economists really haven't had to deal with for decades? To really get what's going on, you have to think like an economist for a second. It's all about weighing the negatives, the things slowing us down, which they call headwinds, against the positives pushing us forward, the tailwinds. So first, let's talk about what's really holding the economy back right now.
According to Torsten Slok, a top economist at Apollo, it's not 100 different things. It really boils down to three major headwinds that are dragging on the U.S. economy. Think of these as the main forces hitting the brakes.
And what are they? Well, they're three specific policy decisions. We're talking about tariffs on imported goods, restrictions on immigration, and the restart of student loan repayments. Let's dig into how each one of these is creating a drag.
First up, tariffs. The logic here is actually super simple, and Walmart said it best. When you slap tariffs on imported goods, they get more expensive. When prices go up, people buy less stuff. Sales go down. It's a double whammy. It slows down economic growth and pushes inflation higher.
The second headwind, immigration restrictions. A policy that aims to reduce the number of people in the country by around 1 million, well, that directly shrinks the labor supply. You end up with worker shortages, and that can drive up wages and therefore prices in key areas like construction and hospitality. And number 3, student loan repayments. After that long pause we had, they're back. And what that means is millions of Americans now have a lot less cash to spend each month. Less spending money means less fuel for our consumer-driven economy, and that holds back growth. Okay, so those are some pretty serious headwinds. Is there anything pushing back in the other direction? Yes, there are some tailwinds, but the real question is, are they strong enough to even matter? Let's see.
So, there are some positives. The stock market's been pretty strong, and it's still relatively easy for good companies to borrow money. Plus, everyone's kind of hoping the Fed will start cutting interest rates, which would help. But, and this is a big but, the experts say these tailwinds are more like a gentle breeze compared to the powerful headwinds we just talked about. They're just not strong enough. So when you have powerful forces slowing things down and only weak forces pushing things forward, you get a slowdown. But this isn't your parents' recession. This is something else entirely.
This table from the Bloomberg Consensus Forecast basically tells the whole story. Just look at that top line. Real GDP growth. It's expected to slow way down. Now you'd think that would mean prices would cool off, right? But look at the bottom line. Inflation is forecast to stay stubbornly high, right around 3%. Slower growth and high inflation at the same time. That's the problem.
And there's a word for this really weird and nasty combination, stagflation. It's a huge headache for regular people, it's a nightmare for the Federal Reserve trying to manage the economy, and you guessed it, it's a super tricky environment for investors. So that brings us to the most important question, right? What does this all mean for your money? How in the world are you supposed to invest when the economy is slowing down, but prices are still going up?
Before we even get into strategy, you have to understand this one massive change in the markets. The number of companies you can buy on the stock market has literally been cut in half. That means a huge chunk of economic growth is now happening in private markets, which have a whole different set of rules and risks, especially when things get tough.
So how do you play it? Well, the consensus advice from the pros is to focus on safety. The strategy is to move up in quality. And what that really means is you want to be in companies that are built like fortresses. Businesses with low debt, strong, steady cash flow, and the power to raise their prices without losing all their customers. The kind of business that can survive a storm.
This whole situation also forces us to think about building a portfolio in a totally new way. For decades, it was a two-dimensional game, balance risk and return. But now, strategist Larry Hathaway says you have to add a third dimension, liquidity. In plain English, that just means how fast can you get your hands on your cash if you need it? In times like these, that question becomes absolutely critical.
So it really is a new ballgame. It's no longer about just chasing the highest possible returns. It's about building a portfolio that's durable, high quality, and takes all three of those dimensions, risk, return, and liquidity, into account. And that really leaves us with the one critical question every single investor needs to be asking themselves right now. Is my strategy truly built for the complex road ahead?